You know, folks, I've been in this business for over 4 decades now. 4 decades. And in all that time, advising high net worth individuals, managing portfolios worth hundreds of millions, sitting on boards of some of the most prestigious financial institutions in this country. I thought I'd seen it all. I really did. But just last month, and I'm telling you this story because it perfectly illustrates what we're going to talk about today. Just last month, I'm sitting in my office on the 47th floor of the Chrysler Building. You know, the one with the view of Central Park that my wife always says is wasted on someone who spends his day looking at spreadsheets instead of the scenery. Anyway, I'm sitting there when my phone rings. It's Margaret. Margaret Thompson. You might know her. She runs Thompson Capital Management out of Chicago. Brilliant woman. Absolutely brilliant. MBA from Wharton, just like mine, actually graduated 2 years after me. She's called me probably, maybe a dozen times over the years for advice on particularly tricky investment strategies. But this call was different. Jim, she says. That's what she calls me, Jim, even though most people call me James. Jim, I need to tell you something that's going to shock you. My client just got audited by the IRS. Now, you have to understand, Margaret's clients are, well, let's just say, they're not your typical middle-class families. We're talking about people with investment portfolios in the 8-9-figure range, people who have teams of CPAs, tax attorneys, the whole 9 yards. So I'm thinking, okay, an audit, that happens, especially with high net worth individuals. The IRS, they love to go after the big fish, right? It's like a fisherman going to where he knows the biggest fish are swimming. Makes sense from their perspective. But then Margaret says something that made my blood run cold. She says, Jim, they got audited because of a home office deduction. A $1,700 home office deduction. $1,700. Let me say that again. $1,700. This is a client who probably pays more than that in taxes every single week. Every week. And the IRS decided to audit them over a home office deduction that wouldn't even cover a decent weekend at Martha's Vineyard. Now, I want you to lean in here, because this is where it gets really interesting. This client, and Margaret couldn't give me all the details because of confidentiality, you understand, but this client had done everything right. They had a dedicated office space in their home. They used it exclusively for business. They had all the documentation, square footage calculations, utility bills, the works. Everything you're supposed to have. But here's the thing that stunned me, and this is why I'm talking to you about this today. The IRS didn't audit them because they thought the deduction was fraudulent. Oh, no. They audited them because their algorithm, and yes, the IRS uses algorithms now, just like Netflix uses algorithms to recommend movies. Their algorithm flagged this return as suspicious. Why? Why would a legitimate, properly documented home office deduction trigger an audit? Because, and this is what most people don't understand, the home office deduction has become what I call a red flag magnet. It's like, you know when you're driving on the highway and you see a car pulled over by the police? Even if you're doing nothing wrong, even if you're going exactly the speed limit, you instinctively slow down, right? You don't want to attract attention. Well, the home office deduction is like driving a bright red Ferrari in a 35 miles per hour zone. David's a tax attorney, works for one of those white shoe law firms on Wall Street, you know the type, charges $800 an hour and worth every penny. We're at the Four Seasons, the old Four Seasons before they tore it down, God rest its soul. And David tells me something that still gives me chills. He says, James, David always called me James, very formal, very proper. James, I've got a client who's been claiming the home office deduction for 15 years. 15 years, never had a problem. Same house, same office, same business. Last year, boom, audit. Now, this wasn't some small-time operation we're talking about. This was a Fortune 500 CEO, a man whose annual salary was, well, let's just say it had a lot of zeros. And the IRS decided to spend months auditing his $3,200 home office deduction. You know what they found? Nothing. Absolutely nothing. The deduction was completely legitimate. But here's the kicker, and this is what David told me over our second bottle of wine that afternoon. The audit cost the CEO more in legal fees and accountant. Fees than he'd claimed in home office deductions over the past 5 years combined. 5 years. Think about that for a minute. The cure was more expensive than the disease. Now, I want to be very clear here. I'm not telling you this to scare you away from legitimate tax deductions. God knows, with the way this government spends money, and I don't care whether you're Republican, Democrat, or somewhere in between, with the way they spend our money, we need to take every legal deduction we can get. What I'm telling you is that you need to be smart about it. Strategic. You need to understand the game that's being played here. See, the thing is, the home office deduction has been abused, massively abused. I've seen people try to deduct their entire mortgage payment because they answered business emails from their kitchen table. I've seen people claim their master bedroom as a home office because they sometimes read business documents in bed. There was this one case, and I won't mention names because the poor guy's been through enough. But there was this entrepreneur out in California who tried to deduct 75% of his house as a home office. 75%. This is a 8,000 square foot house in Malibu, and he's claiming that 6,000 square feet of it is exclusively used for business. When the IRS came knocking, and of course they came knocking, they found out he was using his home office to host dinner parties. His kids were doing homework in there. His wife was using part of it as a yoga studio. The exclusive business use test failed spectacularly. But here's what's really insidious about this whole situation. The IRS knows that legitimate business people are going to be scared away from taking the home office deduction because of stories like these. They know it, and they're counting on it. It's like, you know how sometimes the most effective way to control behavior isn't to punish everyone who breaks the rules, but to make a few very public examples? That's exactly what's happening here. I was talking to my old professor from Harvard Business School just last week. Professor Williams. He's probably 80 now, still sharp as a tack. He taught me more about business strategy in one semester than some people learn in their entire careers. We were reminiscing about the old days. You know how it is when you get to be our age, and he said something that really stuck with me. He said, James, the tax code isn't just about raising revenue anymore. It's about behavior modification. Behavior modification. Think about that. The government is using the tax code to influence how we run our businesses, how we structure our investments, even how we live our lives. And the home office deduction, that's ground zero for this psychological warfare. Now, let me tell you about a client of mine. I can't use his real name, so let's call him Robert. Robert owns a small manufacturing business in Ohio. Been running it for 30 years. Built it from nothing into a $50 million operation. Real American success story, you know? Started in his garage. Now he's got 200 employees. Robert's always been meticulous about his taxes. Has to be in manufacturing. The regulations, the environmental compliance, the worker safety requirements, everything has to be documented. Everything has to be perfect. So when he set up a home office for his administrative work, he did it right. He converted his basement into a proper office. Separate entrance, business phone line, the works. He even had it professionally measured by a surveyor to make sure his square footage calculations were exact. Exact. This is a guy who doesn't leave anything to chance. For 12 years, Robert claimed the home office deduction. 12 years, no problems. Then, in 2022, boom, audit letter in the mail. Robert calls me up. And I'll never forget this conversation because it was on a Friday afternoon, and I was getting ready to leave for the weekend, head out to my place in the Hamptons. Robert calls me up, and he's practically in tears. Not because he's afraid he did something wrong, but because he knows what this means. He knows he's going to have to shut down his business operations for weeks while he deals with this audit. He's going to have to pull his controller, his CFO, maybe even his operations manager into this mess. He's going to have to pay his lawyers, his accountants, maybe even hire a specialist. And for what? A $4,800 deduction. $4,800. Now here's where the story gets really interesting. Robert, being the thorough guy that he is, decides he's not going to roll over. He's going to fight this thing. He hires the best tax attorney in Cleveland, a guy named Peterson, charges $600 an hour, and they start preparing for war. Peterson tells Robert, and I love this because it shows you how the system really works. Peterson tells Robert that the IRS agent handling his case is probably carrying a caseload of 300 to 400 audits. 300 to 400. Can you imagine? This poor agent is supposed to thoroughly examine 400 tax returns, and they're all supposed to be done within 18 months. So what does the agent do? They focus on the easy targets, the obvious mistakes, the deductions that look suspicious on the surface. They don't have time to dig deep into every case to really understand the nuances of each situation. Robert's case was supposed to be one of those easy targets. Small business owner, home office deduction, probably cutting corners somewhere, but Robert had done his homework. He had every piece of documentation you could possibly want. Photos of the office space taken from multiple angles, utility bills going back 7 years, business phone records, even testimonials from employees who could verify that he conducted business meetings in that office. The audit took 8 months. 8 months. And in the end, the IRS agent had to admit that Robert's deduction was completely legitimate. Not only that, but they found a couple of other deductions that Robert had missed and could have claimed. But here's the kicker, and this is why I'm telling you this story. The whole process cost Robert more than $35,000 in legal and accounting fees. $35,000 to defend a $4,800 deduction. Now, Robert could afford it. His business was doing well. He had good cash flow. But what about the small business owner who can't afford to fight? What about the freelancer, the consultant, the online entrepreneur who's just trying to make ends meet? They fold, they settle, they agree to pay penalties and interest on deductions that were perfectly legitimate just because they can't afford to fight. And that, my friends, is exactly what the IRS is counting on. I had dinner with my old colleague from Goldman Sachs last month. Tom Bradley, some of you might know him. He was featured on the cover of Fortune magazine a few years back for his work in municipal bonds. Anyway, Tom and I were talking about this very issue, and he made a point that I think is absolutely crucial. He said, James, the home office deduction has become a tax on being honest. A tax on being honest. Think about that for a minute. The people who are truly abusing the system, the ones who are making fraudulent claims, they're not getting caught by these random audits. They're too smart for that. They know how to fly under the radar, how to structure their deductions to avoid triggering the algorithms. But the honest business owners, the ones who are legitimately working from home, who have legitimate business expenses, they're the ones getting caught in the crossfire. It's like, you know how airport security works? The real terrorists aren't getting caught by the TSA agents who make you take your shoes off and throw away your water bottle. The real bad guys know how to get around those measures. But honest travelers, people who just want to get from point A to point B without any hassle, they're the ones who suffer through the delays, the searches, the general inconvenience. Same principle applies here. Now let me tell you something that might surprise you. I've been tracking IRS audit statistics for the past 15 years. It's kind of a hobby of mine, I suppose, and what I found is fascinating. The audit rate for returns claiming the home office deduction is roughly 3 times higher than the audit rate for similar returns that don't claim that deduction. 3 times, even when you control for income level, business type, and other factors. But here's what's even more interesting. Of those audits, about 60% result in no change to the tax return. No change. That means the majority of people who get audited for their home office deduction were completely in the right. So why does the IRS keep doing it? Why do they keep auditing legitimate deductions? Because it works. It generates revenue, not necessarily from the audits themselves, but from the chilling effect it has on other taxpayers. For every Robert who's willing to fight, there are probably 50 other small business owners who decide it's not worth the risk and stop claiming the deduction altogether. I remember a conversation I had with IRS Commissioner, former Commissioner now, John Smith. This was at a conference in Washington, must have been 2019 or 2020. We were having drinks after one of those boring panel discussions about tax policy, and I asked him point blank about this strategy. You know what he told me? He said, James, compliance through intimidation is still compliance. Compliance through intimidation? The man actually said that, with a straight face. Now, I want to be clear here. I'm not anti-IRS. I understand they have a job to do. Tax collection is essential for funding government operations, and there are plenty of people out there who are genuinely trying to cheat the system. But what's happening with the home office deduction isn't about catching cheaters. It's about creating fear. And fear, as any good investor will tell you, is the enemy of rational decision-making. Let me give you another example. I've got a client, let's call her Sarah, who runs a very successful consulting business. She's got clients all over the world. Fortune 500 companies, government agencies, the works. Sarah makes good money, pays her taxes, contributes to her community. When the pandemic hit and everyone started working from home, Sarah decided to formalize her home office setup. She'd always done some work from home, but now it was going to be her primary workspace. So she converted her spare bedroom into a proper office. New desk, business-grade internet connection, professional lighting for video calls, the whole 9 yards. Spent about $15,000 setting it up, which for someone in her income bracket was a reasonable business investment. Come tax time, Sarah's accountant, a guy I've known for 20 years, very conservative, very by the book. Her accountant tells her she shouldn't claim the home office deduction. Why? Not because she doesn't qualify, not because the deduction wouldn't be legitimate, but because he's afraid it will trigger an audit. Sarah, being the smart businesswoman that she is, asks him to quantify the risk. What are the odds of an audit? What would be the likely outcome? What would it cost to defend? Her accountant, and I've had this same conversation with dozens of tax professionals, her accountant tells her that while the deduction would probably be upheld if audited, the cost of defending it would likely exceed the tax savings. So Sarah makes the rational business decision. She doesn't claim the deduction. She pays more in taxes than she legally owes just to avoid the hassle and expense of a potential audit. Multiply that story by thousands, maybe tens of thousands of small business owners across the country, and you start to see the scale of what's happening here. The IRS is collecting taxes on income that should be offset by legitimate business deductions. They're doing it without passing any new laws, without raising tax rates, without any of the political battles that usually accompany tax increases. They're doing it through fear. Now, some of you might be thinking, well, if you're doing everything right, if you have all your documentation, what's the problem? Just take the deduction and deal with an audit if it happens. And you know what? That's not wrong. That's actually the advice I give to most of my clients who have substantial resources and can afford to fight if necessary. But here's what you need to understand about IRS audits. It's not just about proving you're right. It's about the process itself. When you get audited, your life stops. Your business operations get disrupted. You have to gather documents, some of which might be years old. You have to explain decisions you made months or years ago. You have to relive every business expense, every calculation, every judgment call. And even if you win, even if the audit results in no change to your return, you've lost. You've lost time, you've lost money, you've lost peace of mind. I've seen successful entrepreneurs, people who've built multi-million-dollar businesses from scratch, reduced to nervous wrecks by IRS audits. Not because they did anything wrong, but because the process itself is so stressful, so invasive, so disruptive. There's a psychological term for this: learned helplessness. It's when an organism stops trying to escape or avoid negative situations because they've learned that they have no control over them. That's what's happening with the home office deduction. Business owners are developing learned helplessness. They're giving up legitimate tax benefits because they feel like they have no control over whether they'll be audited. And the IRS knows this. They count on it. But here's the thing, and this is why I wanted to talk to you today. You do have control. You do have options. You just need to understand how the game is really played. First, let's talk about the numbers, the cold, hard statistics that most tax professionals won't tell you because they don't want to deal with the liability. In 2023, the IRS audited approximately 0.6% of all individual tax returns, less than 1%. But for returns claiming the home office deduction, that number jumps to about 1.8%, still less than 2%, but 3 times higher than the baseline. Now, here's where it gets interesting. Of those audits, about 40% are what they call correspondence audits. These are the audits that happen through the mail. You get a letter asking for documentation, you send it in, they review it, and that's usually the end of it. The other 60% are field audits or office audits, where you actually have to meet with an IRS agent. These are more intensive, more stressful, and yes, more expensive to defend. But here's what most people don't realize, and this is crucial. The type of audit you get often depends on how you present your deduction. If you just take the home office deduction without any supporting documentation, without any clear business justification, you're much more likely to get a field audit. The IRS assumes you're probably cutting corners elsewhere too. But if you document everything meticulously, if you follow all the rules to the letter, if you make it clear that you understand exactly what you're doing, you're much more likely to get a correspondence audit, if you get audited at all. It's like the difference between getting pulled over for speeding in a beat-up car with expired registration versus getting pulled over in a well-maintained vehicle with all your paperwork in order. Same violation, but the officer's approach is going to be very different. So, what does proper documentation look like? Let me walk you through exactly what I tell my clients. First, you need to establish exclusive business use. This means the space you're claiming as a home office is used only for business, not sometimes for business and sometimes for personal activities, only for business. I had a client who learned this lesson the hard way. He was claiming his spare bedroom as a home office, but his wife was using it as a craft room on weekends. When the IRS audited him, they discovered this through social media photos his wife had posted on Facebook showing her quilting project set up in the office. The deduction was disallowed and he had to pay penalties and interest on the underpayment. The lesson? If you're going to claim a space as a home office, treat it like a real office. Don't let family members use it for personal activities. Don't store personal items there. Don't let it become a catch-all room for household clutter. Second, you need to document the business use. This means keeping records of the business activities you conduct in that space. Client meetings, phone calls, administrative work, whatever it is you do there. One of my clients keeps a simple logbook where she records every business activity she conducts from her home office. Date, time, duration, purpose. Takes her maybe 30 seconds per entry, but it creates a paper trail that clearly establishes business use. Third, you need accurate measurements and calculations. The IRS is very particular about this. They want to know the exact square footage of your office space and the exact square footage of your entire home. Don't guess. Don't estimate, measure it properly, or better yet, have it professionally measured. I know it seems like overkill for a tax deduction, but remember, the IRS is looking for reasons to disallow your claim. Fourth, keep all your supporting documents, utility bills, mortgage statements, repair and maintenance records, anything that shows the costs associated with maintaining your home. You'll need these to calculate your deduction and to defend it if you're audited. And here's a pro tip that most people don't know. Take photos. Lots of photos. Document what your home office looks like, how it's set up, how it's used. If you ever get audited, these photos can be worth their weight in gold in establishing that you are using the space exclusively for business. I remember one case where a client was being audited, and the IRS agent was skeptical about whether the home office was really used exclusively for business. But my client had taken dozens of photos over the years, showing the office at different times, documenting business meetings that had taken place there, showing how the space evolved as his business grew. The agent took one look at those photos and said, "Okay, I'm convinced. This is clearly a legitimate business space." Now, let's talk about the simplified method versus the actual expense method. This is where a lot of people make mistakes that end up costing them money. The simplified method allows you to deduct $5 per square foot of home office space, up to a maximum of $1,500 per year. It's easy to calculate, requires minimal documentation, and is much less likely to trigger an audit. The actual expense method allows you to deduct the actual costs of maintaining your home office, utilities, repairs, depreciation, etc. It can result in a larger deduction, but it requires much more documentation and is more likely to attract IRS attention. Most tax professionals will automatically recommend the simplified method because it's easier for them and less risky. But that might not be the right choice for you. I had a client in California who was using the simplified method and only claiming $1,500 per year. But when we sat down and calculated his actual expenses, he was entitled to deduct more than $8,000 per year. $8,000 versus $1,500. That's a significant difference in tax savings. We switched him to the actual expense method, documented everything properly, and he's been claiming the full deduction for 3 years now without any problems. The key is understanding your situation and making an informed decision based on your specific circumstances, not just going with whatever seems easiest or safest. Now let me address the elephant in the room. Some of you are probably thinking, this all sounds like a lot of work for a relatively small tax deduction. Is it really worth it? And that's a fair question. For some people, the answer might be no. If your home office is small, if your business income is relatively low, if you value simplicity over tax savings, then maybe the home office deduction isn't for you. But for many people, especially in today's economy, where more and more people are working from home, the home office deduction can represent significant tax savings over time. Let's say you're a consultant earning $150,000 per year, and your legitimate home office deduction is $6,000 annually. If you're in the 24% tax bracket, that deduction saves you $1,440 in federal taxes each year. Over 10 years, that's more than $14,000 in tax savings. $14,000! That's a nice vacation, a new car, a significant contribution to your retirement savings, and that's just federal taxes. Depending on where you live, you might also save on state taxes, bringing your total savings even higher. The question isn't whether the deduction is worth pursuing. The question is whether you're willing to do it right. Here's what I tell all my clients. If you're going to claim the home office deduction, treat it like a business decision. Do your research, understand the requirements, document everything properly, and be prepared to defend your position if necessary. Don't just hand your receipts to your accountant and hope for the best. Take ownership of the process. Understand what you're doing and why you're doing it. And here's something else that's important. Don't let fear make your decisions for you. Yes, claiming the home office deduction might slightly increase your audit risk. But as we've discussed, that risk is still relatively small. And if you're doing everything properly, an audit should result in no changes to your return. The bigger risk is leaving legitimate tax savings on the table year after year because you're afraid of something that probably won't happen. I think about my friend Margaret's client, the one I mentioned at the beginning of this talk. Yes, they got audited. Yes, it was inconvenient and expensive, but you know what? They kept claiming the home office deduction the following year because it was legitimate and they were entitled to it. That's the attitude you need to have. You're not trying to cheat the system. You're not trying to get away with something. You're simply taking advantage of legal tax provisions that Congress put in place specifically to help people in your situation. The home office deduction exists for a reason. It recognizes that more and more people are running legitimate businesses from their homes, and that they should be able to deduct the legitimate expenses associated with that business activity. The fact that some people abuse it, or that the IRS has decided to audit it aggressively, doesn't change the fundamental fairness of the deduction. So here's my advice, and I'm going to give it to you straight, the same way I'd give it to any of my private clients. If you have a legitimate home office that you use exclusively for business, claim the deduction. But do it right. Follow all the rules, document everything properly, and be prepared to defend your position if necessary. Don't let the IRS intimidate you into paying more taxes than you legally owe. That's exactly what they're counting on, and it's exactly what you shouldn't give them. At the same time, don't be reckless. Don't try to push the envelope or claim deductions you're not entitled to. The aggressive audit strategy I've been talking about means the IRS is looking very carefully at home office deductions, and if you're cutting corners, you're likely to get caught. The sweet spot is in the middle. Be aggressive in claiming legitimate deductions, but be conservative in how you interpret the rules. And remember, this isn't just about taxes. This is about the broader principle of financial self-determination. Every dollar you save on taxes is a dollar you can invest in your business, your family, your future. Over the course of your career, proper tax planning can save you tens of thousands, maybe even hundreds of thousands of dollars. Those savings compound over time, just like investment returns. The home office deduction might seem like a small thing, but small things add up. And in today's economic environment, every advantage matters. So don't let the IRS scare you away from legitimate tax benefits. Understand the rules? Follow them carefully and claim what you're entitled to claim. That's how you build real wealth. That's how you secure your financial future. And that's how you beat the IRS at their own game. Thank you.